be asked to moderate this session on U.S. oil and gas exports, which I believe hits at the focus of the Tulsa conference as exports reflect the energy self-sufficiency of the country. We have a distinguished panel today, each of which will speak for around 20 minutes, followed by Q&A. We are, first up, we've got John Downey, who yesterday was the recipient of the USAEE Senior Fellow Award. And that's followed by Kathleen Eisbrenner, who is founder, chairman, and CEO of Next Decade. And then Chris Henderson, from, who's the North American LNG analyst for S&P Global Platts. And John, I'll hand the floor over to you.
Thank you very much. I appreciate the opportunity to speak here. Exports is an issue I've been working several years at API, and it's one of those few ones that I can say we won. It took a long time, but we won. And it was against, shall we say, a whole lot of silly arguments that I'll go into, but it's kind of nice to just kind of wonder. So I spent a lot of my life traveling around the country talking about potential oil exports. And there are times when you go into a foreign city and you open up the newspaper and you go, oh my God, that's me. And you see your ugly mug staring back at you this was from the business section, front page of the business section of the Houston Chronicle a couple of years ago. And I just went, boy, that was a good picture. You took it with a cell phone camera with no lighting. And my wife saw this line, she said, you're not using that picture to promote yourself, are you? And I said, no, but I had a good discussion with the energy writer at the Chronicle, and I tried to distill it down into something of saying, you know, we've got this mismatch in refinery capacity and oil production in the U.S. Why aren't we exporting the expensive stuff and import the cheap stuff that we can use more in our refineries? Try to distill it down to just a simple point. And fortunately, I got it into the article and so on, but it was truly scary. I mean, when I've traveled, given a lot of speeches over my life, I'd go out to these small towns somewhere, well, smaller cities, where not necessarily everybody likes API. And I'll do an interview with a newspaper, and they'll put my picture on the front page, and then I go, oh my God, they know what I look like. Which, in some cases, is really scary. So that was one that I started to, I've kept, and actually our communications folks back in API framed the original. A friend of mine who lives in the Woodlands sent me the original newspaper article, and he framed it. So I use it as a kind of an example of what you have to do. Now, you know, some of the things that I put into here are, how long have we been exporting oil in the United States? Anyone know, kind of guess when the first oil export from, but what was the exact date? Well, you don't need the exact date, but it was, of course, on November 19th, 1861, from the Port of Philadelphia, in, I believe it was the 42-gallon barrels that had been shipped by rail from northwestern Pennsylvania down to Philadelphia. And for a long period of time, the U.S. financed quite a bit of its budget deficit by taxes on exports, export oil, and so on. Because in the 1870s, the northwestern part of Pennsylvania, which was where they originally found commercial oil, supplied something like 80% of the world's crude oil. And so we've been doing this for a very long time. And, we did it over years and so on, and then suddenly it changed. And it's like, you can see here, for example, some of the crude exports over the years. It only goes back to 1920, but most of those are tied toward conflicts, Suez, things like that. But then with the opening of Alaska, you had more oil available, and even though you couldn't export it from Alaska initially, you still had exports increase. So this is nothing new. I mean, we've been doing But there have been a lot of arguments against it. And then what happened? This changed. This is the gas lines of I think this one is from the 1973. I first started studying energy in '73 when I was on the Penn State debate team. Yes, I am a Penn Stater. I've always heard of Penn State ties. And as Mike announced, they won on Saturday night. But the topic was energy. And it was basically, resolve the federal government should control the supply and utilization of energy in the United States as though they could. They tried, and we know what happened. And everybody interpreted this as being the OPEC embargo, and so you had this sudden rush to, well, you're going to have energy security, and so on and so forth. Even though all it was price controls and allocation controls. Gas didn't get where it was supposed to be, and so, those are the things that happened. But, so in '75, they passed a law banning exports. So for 40 years, we couldn't do it in the United States, no matter what happened with hydraulic fracturing and so on and so forth. So now why do people argue that we shouldn't export oil? Well, there are a couple really silly arguments. One of them made by a very famous investor that it's a security issue. I'll let you guess who that very famous investor was. No, it's not a security issue, of course. Others, some union folks, argued that you just want to export crude oil so it's refined internationally. But, that's what you deal with when you have these arguments like that. Now, a legitimate question was, well, what happens with prices? If you export, you have more increased demand. What does that do in terms of price? And I'll turn to that in a moment. But it comes down to, really, as a good economist, it comes down to how flat or steep is the supply curve if you have a shift in demand and so on, and whatever the dynamic purpose of it is. Those of you who are old enough to remember green stamps. I remember vividly, as a poor kid, that was the only way I could ever buy Christmas presents for people. Save up green stamps throughout the year, back when they had green stamps. And of course, you couldn't buy any gas, so you couldn't get any green stamps, but nevertheless, that's what you're doing. And we also had this event happen. The Club of Rome, limits to growth. We've got to conserve this stuff because we're going to run out of everything. Well, if you believe them, we would have run out of everything about 15 years ago. But it didn't happen. Obviously, we've been supposedly running out of oil since 1874, when the geologists of Pennsylvania said we'd run out in 4 years. And then you had, waves and waves and waves of running out arguments and so on. And it all played into, well, we don't want to export oil, we need to keep it here and so on. I think it's Dan Yergin who said we've run out of oil 4 times already. So that's the challenge that we faced when we started this discussion with politicians in Washington on how do we move forward with getting it. Fortunately, we had some really good staffers to work with, and they had a session earlier in the morning talking about transitions and whatever. And the one thing you learn when you work in Washington and you get to brief people is you're mostly briefing younger people who weren't around in 1975. So you've got to first of all give them some history and so on. And you don't generally talk to a member for a long time, except our lobbyists for fundraisers and so on, and then they're willing to talk to you. But in general, you spend your time talking with younger folks and getting them briefed on it so that they can pass along to their members, this is what the reality of energy is and so on. And it takes a long time. I only ever got to brief a couple members over the years, and it's truly amazing the variation in terms of the representation you have between different members. And it's incredible and actually scary, but that's a different story. So anyway, let me turn to what are we talking about in terms of the price impacts. Well, I have to show this chart every speech because they'll take my degree away if I don't. But it comes down to how flat is the supply curve from a static sense. So if it's virtually flat, then a shift in demand doesn't give you much price impact. And virtually all the studies that have been out there of crude oil exports, and I won't talk much about LNG because my experts behind me will deal with that more, but it's the same with natural gas. In a static sense, If you have a shift in demand, you don't have much of a price impact, but you really do have positive economic benefits from those types of exports. Now, in a dynamic sense, if you have, suddenly people say, oh, you're going to allow exports, so I want to gear up my production, then you have, in addition to a shift in demand, you have a shift in the supply curve, and you can actually have price declines. And that's really the empirical question on this. As I said, most of the, well, virtually all the studies, you can't say virtually all, but most of them, that's what the conclusions are. And so, you know, finally, I think we've got some good news in Washington that they said, well, okay, let's look at this issue, and then it comes down to, well, what are you negotiating for? In other words, what are you going to give up to be able to do that? And I won't touch on that because I don't know what the ultimate outcome and whether it was a good deal for the industry. But there's no question we've seen crude oil exports, we've seen natural gas exports. You know, in the gas situation, we did have somebody opposing gas exports because they said, well, no, we want to export manufactured products. Well, I think that LNG is a manufacturer. It goes through a lot of processing to be able to be exported, and there's value added and so on. But, you know, that didn't always be well received. So hopefully we'll see some real positive things in terms of this. Then the question is, going forward, what's going to happen in terms of exports? And one of the things that I couldn't do when I was at API was forecast basically anything because of antitrust law. Now I can, and you know what? Nobody's asking me. Which, when I was dealing with reporters over 17 years, they'd say, what's your forecast for oil? I'd say, first of all, if I could forecast the price of oil, I wouldn't be sitting. I'd own, you know, a desert island somewhere. But I can't because of antitrust law, whether it's oil or natural gas and so on. So the outlook is going to be more characterized by the folks who follow me on this in terms of what the opportunities are or what the costs. But again, I think it comes down to why don't you export the expensive stuff and import the cheap stuff? And then you, on benefit, will succeed as a country. And so with that, I will say thank you and turn it over to the next speakers.
Thank you very much. It's a pleasure to be here. Call my slides. I get to speak on my favorite subject. I've been in natural gas for 34 years and in liquefied natural gas for about half of that, and have done some really fun things over the years. It's a very interesting time right now for us in the industry, and as I think about what the opportunities are and what the challenges are, we'll talk about that. Certainly, big news for this year is the emergence of the U.S. as an exporter of LNG. But we're also doing that, we're starting it, launching it, in the midst of a rebalancing that's taking place between supply and demand. So I'll go through some of the math associated with that to set the stage. But probably the most exciting thing that I think is happening right now is on the supply side of gas here in the United States. So I'm going to spend some time talking about that because I really think there's a paradigm shift that's about to take place. And then if we have time, Tina's going to help me watch the time, right? Thanks. I'll tell you a little bit about the projects that Next Decade's working on. Okay, thanks. So first of all, just reflecting on this year, just the last 10 months. You know, we've seen oil at $26 and we've seen oil at almost $54. $54 is better than 26. I have learned that. And it's had implications. Many projects actually are starting to fall off the development map in the LNG space. And that's potentially unfortunate. It's fortunate for those of us who continue to develop export projects. But at the same time, when you look at this scale here and you see some of the milestones that have been achieved, we've exported gas now to Asia, we've exported U.S. gas to Europe, we've exported U.S. gas to South America, and we're utilizing the Panama Canal. So really from a beginning of an industry launch perspective, this has been a very, very exciting year. If you look at all of the announced LNG export projects around the United States, the map looks a lot like it did 10 years ago when everybody was thinking about importing LNG into the United States, including yours truly. There's about 200 MTPA of either pre-filing, in process, approved, or under construction LNG export projects. And this list gives you a little bit of a highlight. I'll show you some easier pictures how to look at this. But clearly, even some of the projects that have already been approved have not gone under construction yet. And so there's some reasons why, and we'll discuss that. I love this slide because it's simple for one thing, but it really shows that LNG exports around the world really have traditionally been a stranded gas push play. So it's a gas push. It's really only in this decade that it started to become a demand pull from a customer perspective. And I've got a great slide for you economic folks to highlight that in a moment. But the message or the question I want to leave in your minds at this point is what's going to happen in the future? Because I think the future is going to look different than the beginning of this decade has. We are in a process of rebalancing a market. There have been many large projects that have been built, some still under construction and about to hit the market. There was weaker demand growth in Asia in the beginning part of this decade than a lot of people anticipated. But I think you can see, with some question of course, but clearly by the next decade, we will be in a supply short situation again. And so we'll continue to go through this as the market rebalances. But from a macro perspective, what's most exciting is that natural gas, from my perspective, is the fuel for the foreseeable future. The world needs natural gas. I hope we develop solar and renewables and other things for my grandchildren, but for my kids, it's natural gas. And we're seeing that happen in spades. And the fascinating thing for us here in the United States is that the emerging productivity in the U.S. upstream business is phenomenal, and we'll talk a bit more about that. So there's powerful demand forces that are supporting LNG growth. Certainly environmental and political issues are one of those. The fact that renewables are difficult and a ways out, perhaps, in terms of economic competitiveness and timing. But there's also another dynamic, which we're going to talk about, which is the emergence of what the industry now calls FSRUs, floating storage and regasification units. I had the privilege to, with a gentleman here in Tulsa, George Kaiser, develop the first 8 FSRUs around the world. It's really changing the dynamic and allowing many, many new countries to become importers of LNG for the first time. So what does demand growth in the future look like? And I think this is largely Wood Mackenzie data here, talking about how established players, let's say the Japanese, the Koreans, the Spanish, they'll continue to grow. However, the new players will amount to as much as 25% of the new growth. And in fact, I think this is understated. And that's why we've added almost 100 MTPA of expected additional growth. A great example that I just read about on the way here yesterday is Egypt just launched a tender for LNG cargoes. 96 to, Chris tells me, 111 LNG cargoes. To put that in, try to put it in a little bit of perspective. First of all, 10 years ago, Egypt was an exporter themselves. Now they have 3 FSRUs, and they're importing as much as they can, as fast as they can. If you take about 100 cargoes at about 4 BCF a cargo, that's 400 BCF, just say roughly over 18 months, that's a BCF a day of LNG demand that popped up literally almost overnight. That's continuing to happen. Pakistan is installing its second FSRU, and they're looking for their third and their fourth. Growth is happening all over the world. The interesting thing for us as an industry to figure out is, how do we accommodate the challenges associated with that growth? With things, for example, like credit quality. One of the biggest challenges with the Egyptian tender, I see Chris nodding his head, is they keep pushing out the number of days that they're going to promise you to pay for the LNG that you just delivered. It's a bit of a challenge in the industry that we've got to sort through. There. So here's a map, and I know some of these slides are very wordy. They're all on your website. You can print them out. And I'm going to try to just focus on the important messages. But the map shows that there are many countries that are looking to grow through demand growth through FSRUs around the world. And that's going to continue to push up the opportunity for those of us who are now in the export business. And so turning to what I think is the most exciting development in the United States for LNG, I'd like to talk about gas supply. Now, gas supply has fundamentally changed over the last 10 years. It's now, I mentioned earlier, exploration or E&P. It's not E&P anymore. It's either mining or production, but it's a manufacturing process that America is just fantastic at getting better, 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 more, cheaper, cheaper, cheaper. And so that's factoring into the opportunity for the U.S. to be competitive globally for a long, long time. If you look at the bottom right graph, it shows that there's more than 100 TCF of available gas supply that could be produced at less than $2 an MMBTU. In reality, and I'll show you more about this, that graph is being pushed down and to the right. So gas supplies are just becoming more abundant and less expensive. Now, 2 months ago, when I had this slide commissioned, I guess, or drafted, we're developing our project, which is in Brownsville, Texas. I was very, very confident about access to gas supply and liquidity, and in large part because of the incredible finds that have taken place in the Utica and the Marcellus, and the 18 BCF a day of pipeline capacity that is either being built or reversed, which is amazing to think about this, to take all this Northeast gas and bring it back to the Gulf Coast. So we're literally flipping the grid from what used to be market areas are now supply areas and vice versa. So we're in the midst of this, and that's exciting. However, the picture gets even more exciting. If you look at Texas itself, the Permian Basin and the Eagle Ford are two very prolific basins, and more and more investment has been made in these areas. I don't know how many of you picked up on it, but about a month ago, Apache announced a single 75 TCF find in the Permian Basin. 75 TCF. Those of you who aren't in the business, it might be hard to even contemplate, but it's like taking the country of Mozambique and putting it in the middle of Texas. It's just an incredible amount of gas. We're building a 27 MTPA, 6-train, largest facility ever permitted facility. In 20 years, if we fill up all 6 trains, we'll consume 30 TCF. So that kind of puts the 75 TCF into context. Everybody has been living in the world that Henry Hub is liquid, the United States is liquid, on any given day you can buy or you can sell. That's about to change because we cannot consume this gas in this continent. And we likely might not even be able to export it in the quantities that are being found. It's really, really a phenomenal change of events. And we're economic. So here on the left, you can see that the Gulf of Mexico clearly has a leadership position in terms of competitiveness to get to Europe. And on the right-hand side, you can see we're pretty good in getting to Asia. But this dynamic that I've just been talking about, which is the Gulf of Mexico prolificness, isn't reflected in these numbers. Because in these numbers, we're assuming a $3 per MMBTU base. But when you look at the Marcellus and the Utica, that gas is trading at $1.50 less than Henry Hub. Texas is going to trade at $1.50 less than Henry Hub. Sorry, John, I guess I am making price predictions, but, but I really do believe that. So the dynamic is going to be phenomenal. It's going to be phenomenal to watch and to develop. So this is my favorite slide for your team here, Energy Economics. So why did the LNG industry earlier this decade flip from being a supply push to a market pull? So here you see about 5 years of data with the gray line representing the Brent price and the green line representing Henry Hub delivered prices into Asia. And you can see there's a clear arbitrage. That's where everybody was going. First of all, the buyers wanted the lower line, and the developers wanted the higher line. So that created the confluence of interest in exports. Going now, oil crashes. We go from 110 to 50 to 26, and that's reflected in the middle part of this graph. And you can see then oil versus Henry Hub. Hard to see which is going to be different. Looking forward, again, these are reflecting forward curves. They're not reflecting what will really happen, but you can see that two takeaways I have from this. One, Henry Hub is emerging again in terms of the lowest cost supply source and pricing point, and it's much less volatile than crude oil is. So for those two reasons, LNG will increasingly be priced against Henry Hub, or a basis to Henry Hub. So real quickly, just to give you an example of the project that we're developing. We've got 1,000 acres in Brownsville, Texas. We're developing a 6-train, almost 30 MTPA plant, the largest one ever permitted. We've got our free trade agreement, DOE license for 27 MTPA, and importantly for 30 years, which is the longest one that's ever been granted. We think we bring a lot of competitive advantages. We're designing this for economies of scale and simplicity. So there's no novelty in what we're doing, but as you'll see, it's extremely competitive. From a commercial point of view, fortunately, we know almost everybody in the LNG world, and so we've been extremely fortunate to aggregate so far about 30 MTPA of demand around the world. Now it's right now in a non-binding form, because we're about 1 year away from FID. So we're in the process of converting that interest, which is global, into the foundation for supporting our project. And of course, we're located down in Brownsville in that little map, and you can see those gas supplies all around us, and we're extremely, extremely excited about that. We're the closest major port to the Panama Canal, which is going to become increasingly important in the future. And then I think this is my final slide, but timing-wise, we are not the first wave of LNG. We hope to be and expect to be the leader of the second wave of LNG. But what that's allowed us to do, given the current environment, is push costs down, 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 such that we will be able to build with economics that are even better than brownfield economics. So even the first projects that got built that already had tanks and jetties, etc., we're going to be able to beat those costs. And with that, I thank you very much.
Can you guys hear me okay? I have a pretty loud voice, and when I start talking about something I'm excited, I get even louder. So if I get real loud, just wave your hands. My wife kicks my shit when we're sitting at a dinner table. So first of all, thank you very much for having me. It's an honor to be on a panel with Kathleen and John. Kathleen's a trailblazer in the LNG industry. What she's done from an FSRU perspective is incredibly amazing. And I think you guys, if you don't know about FSRUs now, you'll definitely hear about them in the future. So I'm on the LNG desk in Houston. I'm a price analyst. I work with a team in Singapore, Tokyo, and London to price LNG all over the world. We'll get through the legal disclaimer first. So today I'm going to be discussing 3 topics, kind of building on what Kathleen was discussing. I'm going to talk about global LNG capabilities, global supply, global demand. Next, we'll look at liquefaction capacity, and we'll look at liquefaction that we have today and the growing amount of liquefaction we're going to see in the future. And then lastly, we'll talk about pricing mechanisms for global LNG and how U.S. LNG is being priced right now. So before moving to LNG, I came from the natural gas desk. And when you work with data and numbers every day, you sometimes you lose perspective and maybe even more importantly, appreciation for the numbers. Let's look at U.S. natural gas supply. We're around 74 BCF. That's over 20% of global supply. Global supply comes from the United States. So global supply is 335 BCF a day. I love speaking in the United States because BCF is what I feel comfortable with. If we look at global LNG demand, we're right around 32 BCF a day. So global LNG demand is less than half of U.S. gas demand. So as you'll see with my slides, I'm in agreement with Kathleen in terms of future supply for nat gas and the abundance that we're going to have. So why is LNG demand just 1/10 of the global market? Pipeline access still plays a major role, will in the future, and roughly 70% of all gas consumed is consumed in the country where it's produced. If you look at the United States, most of what we consume, except for imports from Canada and a small amount of LNG up in the Northeast, is produced right here. But since 2000, LNG demand has grown around 6.6% a year, and natural gas has grown 2.8% a year. If you look at that compared to other generating fuels, it's very strong numbers. About 114 countries use natural gas as a fuel source, and today just 37 nations import LNG. We see that number growing pretty strongly over the next few years, and really strongly over the next few decades. So, global LNG infrastructure. We have a liquefaction capacity of around 38 BCF a day of global liquefaction demand, of capacity. The utilization rate is around 81%, so a lot of liquefaction that's built today is being used. 19 countries export LNG, and 10 countries re-export LNG. So why would you re-export LNG? Spain built a lot of regasification capacity. As anyone knows, the Spanish economy, EU economy in general, it's a little bit down right now. So if you're going to take in those cargoes, you can re-export them and go to a more premium market, which is something that you'd see maybe in Asia right now. In terms of regasification capacity, we have 757 MTPA, almost 100 BCF a day. The utilization rate is just 32%. Why is that number so low? Well, all of us in the room right here are kind of part of it. Our regasification capacity in the United States is absolutely enormous, and for a supply diversity, European regasification capacity is enormous, and it's being heavily underutilized, partly because of alternative fuels, coal, or just a pretty stagnant economy right now. So as we've discussed in this conference so far, we see natural gas playing a larger role in the future. Exxon just announced that they see 40% of the growth in global energy demand from 2014 to 2040 projected to be met by natural gas. Where does LNG come in with that? IAEA reports that liquefaction capacity is going to grow by 45% between 2015 and 2021. So from an export perspective, the big regions right now are the Asia Pacific and the Middle East. Qatar is just an enormous exporter, and the exports that come out of the Asia Pacific right now are Indonesia, Malaysia, and soon to be Australia. So exports by country, Qatar is just a fascinating story. 10 years ago, Qatar exported their first LNG cargo. Now they're the world's largest producer, just enormous gas reserves. And in just the last year, Australia has catapulted to become the second largest producer of the year. So in just the last year, LNG output has increased by 50%. So as Kathleen discussed, we're going through a wave right now where there's an enormous amount of supply coming online. Indonesia and Malaysia are longtime exporters, and as they are at the doorstep of North Asia, the region that consumes the most LNG. So on the import side, Fukushima really changed the game. When Fukushima happened in Japan, the nuclear capacity came offline, and LNG prices spiked. You had huge margins, and countries like the United States and Australia and a lot of other countries are looking to take advantage of those margins. So it's pretty difficult to understand the idea of why is the Middle East importing LNG? You have enormous gas reserves there, and why is that happening? Well, with the help of FSRUs, demand in the Middle East is growing. Energy consumption on a per capita basis in the Middle East is enormous. So here's a little snapshot of Middle East demand pre-FSRUs, and here's your demand with FSRUs. So the growth in the graphs, those are all from FSRUs, where you're taking liquefaction and regasifying at the sea and bringing it onto the grid. So the FSRU, what I'm trying to portray here in these slides is, with FSRUs, you can bring new demand, countries that are demanding LNG in a relatively small time period. They're able to bring up LNG quite quickly. So this is maybe my favorite slide. Jason Bordoff at Columbia, he tweeted this the other day. And on your left side is the 2005 annual energy outlook of what we thought was going to be our natural gas imports. So we thought we were going to be importing an enormous amount of natural gas via pipeline, mainly from Canada, and importing an enormous amount of LNG. That's why we built the regasification terminals. Well, we were wrong. Everyone just ate a big slice of humble pie. The EIA just announced their 2016 net natural gas imports, and as you can see, we go from, our forecast is from being a large importer to a large exporter. The darker line is pipeline exports, which we're going to be sending quite a bit of gas. We already are sending quite a bit of gas to Mexico, and the red line is what they see as U.S. LNG exports. So why, like I said earlier, why did we and Australia and other producers look to build liquefaction capacity? Well, in Asia, the price that they were paying for natural gas is something that we kind of take for granted. In the United States, extremely high prices. I think the prices peaked around $18 an MMBTU in Japan. In the last 2 years, a lot of people argue that there's a global gas price. I don't think we're there yet, but if you can look at the convergence between NBP in the UK and JKM in North Asia with Henry Hub, the margins are a lot smaller. So as Kathleen alluded to, it's a tighter market right now, but that could change. So definitely smaller margins for the time being. So this graphic is just pretty amazing in terms of, just since February, this is the number of cargoes that have left Sabine Pass off Louisiana. So we've exported 115 BCF on 36 vessels, 34 delivered, and just the diversity of demand is just pretty amazing. We've shipped a vessel through the Panama Canal all the way to China. India has received 4 cargoes, and South America has just been booming in terms of demand. You have Brazil has taken 4 cargoes, and Chile has taken 9 cargoes. So if you look at LNG from a South American perspective, enormous hydro capacity, but when there's droughts or when there's water shortages, in their hydro facilities, they usually make up that energy demand with LNG. So our analytics side, with Bentech and Eclipse, we have a forecast of U.S. LNG liquefaction capacity. We think that next decade will be on there, a little bit after 2020. And so as you can see, a large number of trains, except Cove Point, which is going to be coming on next year, this is all going to be happening on the U.S. Gulf Coast. And I would agree that the discount that you're going to see at certain hubs in the United States to Henry Hub, you're already seeing that in Marcellus, could be very significant. There's a big hub in Appalachia where it's called Dominion South, where gas is traded for $1.24, $1.25. Very, very, very cheap. So here's our U.S. LNG export forecast. As you can see, there's seasonal swings. When there's winter demand globally, utilization and exports will ramp up, and until prices do recover, we'll see what happens with utilization and total exports coming out of the United States. So some of the key stakeholders, the reason why I added this slide is who's interested in U.S. natural gas? Who's interested in U.S. LNG? You have Shell BG. 1 in 5 LNG cargoes that are delivered today come from Shell and BG, so just an enormous, enormous LNG operator. You have GasNap from Spain, Korea Gas, KoGas from South Korea, Gale from India, and Sumitomo from Japan. So a big diversity of consumers from all over the world that are looking to secure U.S. natural gas. So the last part before we move to Q&A is LNG pricing mechanisms. Coming from the nat gas desk, it's so easy to just take for granted Henry Hub. Incredible liquidity. You have hundreds of hubs throughout the United States where you can buy and sell gas. Platts prices 64, 65 and more. You have hundreds of trades where you can really have a liquid price all over the United States. It's not like that, unfortunately, in the rest of the world. So it's a big guessing game. Very opaque, very non-transparent. So in North Asia, where there's not a big gas hub price, they either buy their LNG on a percentage of Brent or JCC, Japan Crude Cocktail, or in Europe, they buy on a hub link price, say a differential to NBP or TTF, or what Platts does, we put out benchmarks and assessments. So talking about some LNG pricing mechanisms for U.S. LNG, we'll talk about Cheniere, the main player in town. They have 2 trains online now, taking in about 1.2 BCF a day, and they're working on train 3. So say we use Henry Hub at $3 today. You add 15%, you're at $3.45. Shell they were able to get a liquefaction fee of $2.25. Now it's important. If Shell decides not to lift their cargo from Sabine Pass, they're still paying that $2.25. So then you have an FOB cost of $5.70. Without adding in the tariffs of the Panama Canal, you can ship to Japan for $1.10. So then you have a delivered ex-ship, a DES price of $6.80. One thing that's really interesting about the Cheniere model is their supply chain responsibility. They take on quite a bit of responsibility. They source the gas, they deliver the gas to their terminal, they liquefy the gas, obviously, and the off-taker simply just takes it from the ship and delivers it to their destination. So there's a lot of speculation of how much they're paying for their gas. They're charging 15%, Henry Hub plus 15%, but what are they buying it at? Are they sourcing it from the Marcellus and buying it cheaper than Henry Hub? It could be cushioning their margins, which is pretty smart of Cheniere. The second is a tolling model, and it's been interesting to see the tolling model slowly playing out in the United States. The supply chain responsibility is completely different. So the off-taker's obligation is in red. So Cove Point, the next terminal coming online, it's very different. So you have Sumitomo, Tokyo Gas, and Gale, all 4 entities that have capacity for Cove Point. So they have to source the gas, they have to deliver it on US pipelines, and the only obligation for Cove Point is to liquefy the gas, and then the off-takers have to have vessels that deliver to their destination. So a much different layout. There's obviously some risks to it, but there can also be some rewards. The last pricing mechanism that we look at is we announced something called the Platts GCM. It's called a Gulf Coast marker. And what we're looking to do is we're looking to price U.S. LNG from an FOB basis, a free on board basis. And why we do this is when we talk to our clients in Singapore and North Asia, they've unfortunately had to deal with buying LNG when it's linked to oil when it's $100, and they are benefiting from it now when oil's at $50. So when it was at $100, their landed cost for LNG was extremely high. So if they're going to buy something linked to Henry Hub, even though I agree with Kathleen that the volatility looks pretty flat, they don't want something that happened in the United States to affect how much they pay for their gas in, say, North Asia. So we're looking to build an independent price. So right now with the limited volatility, with the limited volumes, we're just using a net back. So we have our Platts JKM price, and we have prices all over Europe, and the Middle East, and West India, and what we're doing is we're simply netting back the cost of shipping to come up with an FOB price for the United States. As Professor Ripple spoke yesterday, some markets are in the money, some markets are out of the money. I don't like to get into this too much because it really does change. Right now, Asia's the premium market. France just announced that they're going to be taking quite a bit of their nuclear reactors offline for maintenance in the winter. So TTF could pick up, and Europe could be competing for those U.S. LNG cargoes. It all just depends. So how we do our prices, like I said, we have Singapore covering the Asian market, we have London covering the European and the Middle East, and then our desk in Houston covers the Americas. And so far since June with our pricing, as you can see, the GCM is in orange. We're mainly chasing a West India or a JKM netback. That's for the most part been the premium market to go towards, especially since Brexit and BP has really fallen out. So last slide of the day, future LNG pricing mechanisms. If there's a competitive advantage that the United States has, by 2020 we expect to be the third largest exporter behind Qatar and Australia. When Qatar and Australia when they load a cargo of LNG, their limitations and restrictions of where they can send that cargo are pretty stringent. When a cargo leaves the shores of the Gulf Coast or Maryland for Cove Point, where that cargo can go, it's almost wide open. So they're going to be chasing the premium market. So even though spot and short-term cargoes are around 25% today, we expect spot and short-term cargoes to be almost 50% of the market in just 4 years. So something that could be a little bit advantageous for U.S. LNG operators. And that's my presentation. Thanks guys so much for your attention, and look forward to hearing some good questions.
Well, thank you very much, Kathleen, John, and Chris. Those are very thoughtful presentations. We appreciate it. Now we'd like to open up the floor for Q&A. I've got a number of questions, but I'd like to see if the audience has questions first, and I'll fill in if there's time.
Thank you. Thank you all three of the speakers. My name is Bob Brooks with our BAC. We do natural gas forecasting systems. I'm very interested in natural gas and LNG for that matter. So, one of the things that I'm personally very interested in seeing is anything that's going to help the developing world to do better economically. I personally like the FSRU concept for that because it seems like it opens up an opportunity for lower cost natural gas into the developing world. However, it seems like that what the developing world really needs is electricity, not natural gas. But natural gas, of course, can be used to make electricity. So it seems like a lot of these FSRU projects really, in order to be useful, ultimately need to be tied with power development as well. So that's one aspect of the question, is how much of that is currently going on. Along with one other aspect, which is a negative on this, is I was at a CAPSARC meeting in Washington, D.C. recently, where people from the World Bank were talking about development in the developing world, or financing projects in the developing world. And basically they said all the money that we have for projects goes to renewables, and there's no money for natural gas out of the World Bank. So this is not a very well-defined question, but I'd like to hear Kathleen and the other speakers might respond to that topic.
Okay. Well, it's an excellent topic. Bob?
Yes.
Bob. Excellent topic, and it's not one that I focused on in my presentation, but in our business strategy, it's absolutely a part of next decade's focus. So we're in the process of selecting a rotating equipment provider for our big plant. You know, our plant's going to be $6 billion. A big part of that is the turbines, compressors, equipment. There are really only 3 companies that can make them: Mitsubishi Heavy, Siemens, and GE. Part of our selection process is going to be the willingness of one of those 3 parties to partner with us to do exactly what you just asked about, Bob, which is to provide power equipment in emerging markets so that we are pulling through our LNG into those markets. So it's very much a topic that's on my mind. And it's very important to them. I mean, if you think about it, it's a natural synergy. They want to sell power equipment. And power equipment isn't worth anything if you don't have the fuel supply, you know, to go into it, and an efficient mechanism to make that happen. So I really do believe that we're going to actively try to promote more of that in the future.
Just one quick follow-up. Is this something where the manufacturers could also do the financing on this, or a fee-based type service?
Yes,
So you wouldn't need World Bank money?
exactly. So next decade, we have, you know, fortunately raised $100 million, but it's only $100 million. GE has a $250 billion balance sheet. Siemens has a $95 billion balance sheet. I haven't checked Mitsubishi's. They're in the business of selling their equipment, and they have among the strongest balance sheets in the world. Very much they are open to things like leasing, for example, which could, again, bring the power analogy to FSRUs to be extremely similar. In other words, you know, the commitment levels don't necessarily have to be for a 20-year, you know, time frame. Perhaps, you know, it's a more accelerated time frame than that. So, yes, that's definitely part of the discussions that we're having.
Thank you very much.
Just at one point, Cheniere is already doing this. Cheniere is the only LNG exporter at the moment. And they have a relationship with Chile now to help build a gas-fired power plant that will be fed by Cheniere Exports through a relationship. So that's happening. In terms of Shell, which is just the behemoth in the LNG market right now, Wall Street Journal put out a really good piece about 2 months ago. They're really putting time and a lot of money into trying to decide how to, kind of what the auto industry and the oil industry did 50, 60 years ago. How do we get more consumers of LNG? And they're really going further and further downstream to decide, to determine how can we find more clients and what applications could we use to build out new LNG demand. And then just quickly on your point with the World Bank, agree with you there. There's the Asian Development Bank, and there's some other banks and private entities in Asia that we've identified that are looking to work with developing countries to build gas-fired power plants. So even though World Bank is kiboshed it at the moment, we feel like there are some other avenues for capital financing for some of these gas plants that could be fed by either natural gas or gas plant LNG.
The question is for any of you. I've seen recent forecasts saying, oh, excuse me, I'm Marianne Kaufman Phillips. I've seen recent forecasts that talk about how much an oversupply of LNG will be in the next 2 to 3 years, particularly 2017 to 2019. And these forecasts seem to indicate that 1/3 to 1/2 of U.S. LNG capacity will be shut in because obviously there's no storage for this gas. So I wanted anybody who was willing to comment on this.
Well, I share a concern. You've had so many discoveries of natural gas around the globe. I mean, whoever thought that you'd find natural gas in East Africa or Israel or Egypt? And so those are things that have to be worked out, but that's a significant amount of gas that could be added to the market. And I was going to ask about that, if your thoughts on the East African components of new discoveries.
Well, on East Africa, we'll come back to your question. It just won't compete with the Gulf of Mexico. It's greenfield, offshore, no grid, no infrastructure. That's why I brought up the notion of taking a Mozambique, which is filled with potential, but putting it in the middle of Texas, where we've already got pipes and processing plants and everything, that you need to be able to produce it. It's just, now they do get the benefit, perhaps, of a transportation differential. So we'll see if NG takes their decision to build their small floating liquefaction unit in East Africa, which they said they were going to do by the end of the year.
I could add that none of the forecasts I referenced included East Africa.
Okay.
That was beyond 2020.
Okay. So it's interesting what's going to happen with the existing Sabine facility and then the new ones that are under construction, because in effect, each of those terminals have given the supply switch to the customers. They said, you cover your nut from a tolling perspective, and then you tell me whether to work or not work. And in hindsight, I think that's going to turn out to be a little bit arbitrary. So I don't know if there'll be contract renegotiations, whether Cheniere will just step up and be the remarketer for LNG supplies that are below that contractual threshold. But in the meantime, there will definitely be volatility associated with how to operationalize those contracts. But I think that will get smoothed out by the next decade.
Yeah, just one point on that question. The low prices that we're seeing now and we've seen in the last 18 months, the number of new entrants that have entered the market, I think the development of India, Pakistan, soon to be Colombia that just got their FSRU, low prices incentivize new entrants. So if we're going to have a forecast of low prices for comparatively low prices compared to post-Fukushima for the next 5 years, the new entrants, it's going to be pretty substantial. And once you start importing LNG, it is kind of hard to turn away from it. It has a lot of.
The Qataris, they say it's like a drug.
I didn't want to use the vulgar analogy, but I've read LNG is like crack. Once you start using it, it's very tough to get off. But I didn't want to say it.
It's true.
I have the mic, so I get to go next. Honorable, what I actually want to do, one pet peeve point first. No one is consuming LNG, they're consuming natural gas. LNG is simply a transportation phase. It's a market for natural gas, not a market for LNG. But there are a lot of really great presentations. Chris, I have a question for you on your Gulf Coast market. You said you wanted to have something that was going to be independent, I think was the word you used. But what I'm wondering is, you're talking about netting back from markets. What's determining the price of that market?
Either a gas hub price or, so it's different.